A primary market is where government securities in the form of treasury bills, notes and bonds are first issued. The primary market forms the basis for the local currency bond market or LCBM. The building block on primary market includes 9 policy indicators that support its development, thereby contributing to overall LCBM development. Let's explore these policy indicators. When the government, as an issuer of securities, acts as a price taker, it indicates the adoption of market-based pricing. Market-based pricing is fundamental to providing access to financial markets, extending maturities of debt, establishing a yield curve, and developing the secondary market. When prices are not cleared at market rates, the attractiveness of securities for investors diminishes. Next, the use of market-based issuance mechanisms through auctions or syndications indicates the government's commitment to greater transparency. Predictability in the timing of issuing securities through an auction calendar is also an indicator. It enhances transparency and gives investors and intermediaries time to prepare their balance sheets and helps reduce uncertainty. The ability to produce reliable forecasts of the government's cash flow is yet another indicator. It is critical for predictable and transparent issuance and helps adhere to the issuance calendar. Longer forecast period of cash flows and more frequent updates of forecasts allow the government to maintain a stable bond issuance program during a year. It gives room to efficiently manage temporary intra-year cash shortfalls or surpluses. The next factor is transparency of auction results. This is crucial for market transparency and should be disseminated widely on the day of the auction. The dissemination should include information on bid and accepted amounts, cut-off price, and the minimum, average, and maximum prices and yields of accepted bids. The next factor is regular communication between the authorities and market participants. This results in a better understanding of the supply and demand factors of government securities. Authorities must periodically disseminate information on fiscal balances, debt portfolio risk indicators, the debt management strategy, and the annual borrowing plan. Another important indicator of the primary market is fragmentation. Issuing multiple lines of wholesale debt instruments fragments the LCBM, thereby creating distortions in the primary market bond prices and reducing secondary market liquidity. Where the central bank issues its own securities, the government and the central bank should minimize fragmentation by differentiating tenors and avoiding entering the market at the same time. The central government should also coordinate the issuance of its guaranteed marketable debt. Developing a benchmark yield curve is another important objective. It helps to develop a liquid secondary market as benchmark bonds aim to increase the size of individual securities at key tenors. Benchmark bonds also widen the ownership of securities across a diverse investor base, thereby fostering liquidity through greater trades and supporting to establish a benchmark yield curve. And finally, sound practices in government cash management help to establish a predictable issuance program and to control refinancing risks. Cash flow volatility could be reduced through liability management operations or through the use of cash management instruments. Cash management instruments include maintaining a certain level of cash buffer, issuance of short-term securities like treasury bills, undertaking repo facilities, and through placement of government deposits. In conclusion, the primary market is not only the way the government raises domestic financing, but also the main arena in which debt management strategy is implemented. It is also the ground where the relationship between the debt manager and market participants plays out. Thus, the reliable, efficient function of the primary market is essential for all other elements of the LCBM.